Alright, so welcome to our recorded illustration of sample problem for break-even analysis. Alright, so when we talk about break-even analysis, it's the process of analyzing the relationships between cost and profit with sales volume. So the main aim of the break-even analysis is to determine the break-even point where the cost meets the sales. Okay, you can see in the illustration here those items. Okay, we have profit that is on the purple, sorry, the revenue that is on purple color line. Then if you look into the total cost, that will be the blue line. So the shade darker shade of blue you can see below, that will be fixed cost. As we know, fixed cost generally doesn't change whatever process that we're doing, but again, it depends on the situation. But variable costs will of course change depending on the number of units produced. So the formula, okay, we have this total sales equals fixed cost plus variable cost. If you get the total of fixed cost and variable cost, then you will see the break-even sales revenue. Okay, so when they derive the formula, they have provided here B is equals to fixed cost over the difference between sales revenue per unit and then variable cost per unit. So B here is the units, okay, units to be sold, okay, which is the unknown one. We need to know how many units we need to sell to reach the break-even point. So we have an example here. Motor Music Limited makes a standard model of car radio which sells to car manufacturers for 60 kina. Okay, so 60 kina each. Next year, the business plans to make and sell 20,000 radios. Okay, the business costs are as follows. Okay, so we have in manufacturing, we have variable materials, okay, variable labor, other variable cost. Okay, so variable materials will have 20 kina per radio. Variable labor will be for 14 kina per radio. Other variable cost will be 12 kina per radio. And the fixed manufacturing cost will be 80,000 kina per year. Administration and selling, okay, we have variable 3 kina per radio, and then fixed, that will be 60,000 per year. Okay, so we are being asked to calculate for break-even point, okay, which is expressed in quantity of radios and sales value, and then calculate the margin of safety, which is the difference between the total sales that you will be making against the break-even point. Okay, it should be expressed also in quantity and then sales value. So the solution, we have to determine first how much will be the fixed cost. The total fixed cost in this case will be 140,000 kina. The contribution margin per unit, okay, you can determine that by getting the sales price per unit less the variable cost per unit. So the sales cost, we have 60 kina, which is given. Sorry, sales price per unit 60 kina, and then variable cost per unit, we have to add all the variable costs and expenses that we will incur in producing this product. So we have 20 kina plus 14 kina plus 12 kina plus 3 kina. So that will be around 49 kina. Okay, so 60 kina less 49 kina, we have our contribution margin per unit, that will be 11 kina, right? So using the formula provided previously, we have break-even point, that will be in unit, 140,000 kina, that's for fixed cost, divided by contribution margin per unit. So we arrive at 12,727 radios. Now we have to know what will be the break-even point on sales price or on revenue. That is simple, 12,727, which is the break-even point in units, multiplied by sales price per unit. So we got 763,620 as our break-even point in sales. For the market margin of safety, as I mentioned a while ago, you get the difference between the number of sales that you're supposed to sell against the break-even point. Okay, so we have 20,000 units less 12,727 units. So we have the margin of safety in units 7,273 units or radios. Then to determine the margin of safety in sales volume, you just have to multiply the 60 kina per unit, okay, against that margin of safety in units. So you will arrive at 436,380 kina. And that's it. Thank you for your time. Hope you learned something.